that going for you as well, and so the cost of the mortgage will drop.
Okay.
You know, the idea on that is that with the strong appreciation, let's say you have 5% appreciation in a property and you're putting 10% down, well, in 2 years' time, you're likely going to be able to drop the mortgage insurance.
Yeah.
You know, you can petition that, you know, or refinance, or depending on the situation.
Yeah, that's what I wanted to ask as well. When that time comes, you don't have to refinance, correct, to get that knocked off?
No, it's an option.
Yeah.
You know, refinancing is always an option.
Sure.
Dollars in, you know, what's the benefit?
So it's just kind of making the bank known, whoever that's through, that they kind of hit that, or do they automatically take that off for you?
When you pay the loan down to 78% of the value when the financing was originally done, it will automatically fall off. After 2 years, you have to have the PMI on a conventional loan. You have to have the PMI on for 2 years.
Okay.
After that, if your home appreciated, where you have 25% equity, you can petition the lender to drop the mortgage insurance. But you know, there's a process to do that.
Okay, that makes sense.
And someone would need to reach out to the lender to be able to find out what that process is.
Okay. And then I'll kind of speak, I guess, from my side, but frame it as a question as well. When you said, you know, the difference between putting a little down versus the 20% to take care of the PMI, I would assume what we're looking at really is to say, okay, what is the PMI and what's the opportunity cost of putting that extra money towards the home as opposed to investing or having it for other opportunities?
Yeah, let's say that you know, let's say the PMI is costing an additional 0.5 percentage point, you know, roughly in cost of the loan, and it's one where, you know, if you did have the money, if you didn't have the money, then it's a necessary thing, and hopefully appreciation will eliminate the PMI in the future anyway. And you know, you bought the home at a cheaper price than you would if you saved for the 20% and bought it, you know, in 2 years' time. And so it's just one of positioning on where your assets are best, you know, valued, you know, in time.
Okay, that makes sense. That was, I think, really good for probably newer homeowners. Now let's kind of go on the other end of the spectrum. We work with quite a few folks who are close to retirement or just kind of fresh into retirement, and we were just talking about this earlier, but there's a lot of folks that may move somewhere, you know, whether it's somewhere a little more sunny, although today's nice, or whatever the case might be. So they have had some issues in the past that we've experienced of finding a mortgage. But from what I understand, there are programs out there for retirees. Can you maybe talk to that a little bit?
With the when the housing crisis, you know, the 2008-2009 you know, situation, the government came in and made it clear that lenders should not be, you know, lending to people who cannot afford a loan. And so they made these rules and definitions on what is qualified. And so Fannie Mae and Freddie Mac need to adhere to that, and you know, so that there's a qualified mortgage. And so we have to, you know, run these tests, so there's income to debt ratios and things like that. You know, someone who's retired is, you know, maybe getting Social Security, maybe you know, maybe getting a little IRA, you know, distribution, you know, things like that. It may not be enough to qualify. But what, you know, we can always do is, if there's enough money in their IRAs, we can always increase the distribution and use that new amount to qualify. There's also asset depletion type programs where we can calculate numbers based on the amount of assets they have in order to qualify on a monthly basis.
Okay. Now that doesn't require them actually taking it out, but just showing that there's funds.
Correct.
Okay. That's good to know. Okay. Great. I think that would be extremely helpful, because we've had a few clients in that boat that.
Yeah, that's common.
Okay. And I think what happens is they maybe run into a bank that looks at it differently, as opposed to opening it up to, you know, multiple options to find the best route, probably. Right.
And there are, depending on the situation, sometimes if things don't quite add up and we need to go in and look at their assets and, you know, make some calculations, there may be a higher interest rate, or, you know, it's a non-conforming type of program versus you know, outside the Fannie Mae Freddie Mac box. If we're, you know, However, if there's enough money in an IRA and we increase the distribution based on Fannie Mae and Freddie Mac's formulas with that, then it's still a conforming loan, and they get really good rates.
Okay, that's really good to know. We talked earlier about the difference between fixed and ARMs, and some things to consider there. How about on the more conventional side of the mortgages? So can you talk a little about the difference between loan terms, 15 years, 30 years, what to look out for there?
Well, recommendation on that is a 15 years of forced savings plan.
Mm-hmm.
I'm not a real big fan of the 15-year loan unless someone's nearing retirement and their objective is to pay the home off in a certain period of time.
Mm-hmm.
Otherwise, they could take that same amount of money. You do get a little bit better interest rate on a 15-year loan.
Sure.
But if they took that same amount of money and wisely invested that each and every month, that difference in what they would be paying on a 15-year loan, they're going to be much farther ahead.
Right, and that's because of interest rates right now, right?
Being able to invest that money wisely over time.
Yeah. Okay.
Yeah. So, and then they're maintaining liquidity that way.
Mm-hmm.
Things happen, they can fall back on liquidity.
Right.
It's hard to fall back on equity.
Sure.
Should something happen.
Yeah.
And
yeah.
then that goes back to the home equity line of credit idea.
Yeah.
As well. So.
No, that's really good to hear. That's one of the things we talk a lot about. So I think it'll probably be good to hear from another voice that is the case. So,
yeah.
Yeah. Okay, well, I think that might be a good kind of place to wrap up here today.
Okay.
Is there anything else you want to cover? Anything else that you think folks should know on a high level?
No, just it's always good to explore improving your financing, because you're looking at it long term and you have a lot of compounding effects.
Mm-hmm.
If you're able to save $100, or $150, that's significant.
Sure.
And if you took that same amount of money and put that same amount of money that you're saving on interest toward your loan, and you're going to pay the loan off that much faster.
Yeah.
Given everything else being the same.
Sure.
So it is a great opportunity. These lower interest rates do save people and save families a lot of money.
Mm-hmm. Absolutely. Okay. So if anybody has any questions, wants to get a hold of you, get some help, anything like that, is there a good way to get in touch?
Yeah, they can always reach out to me, email doug.perry@wvmb.com, or my direct number is 206-399-8484, or my office is at 425-453-6669.
Perfect. Well, thanks again, Doug. I think this is going to be really helpful, so I appreciate your time and coming on today. Yeah, of course.
Appreciate it.
Yeah. And thank you for listening to the Mainsail Financial Group podcast series. Hope this is helpful. If you do have any questions for us, please email us at info@mainsailfg.com. That's info@mainsailfg.com.